If you've ever deposited a large amount of cash, sold a car, received money from your kids, moved your own savings between banks, there is a specific dollar amount that triggers an automatic federal report. Your bank doesn't ask your permission. They don't tell you what's happening. The report goes directly to a federal agency most Americans have never heard of. But here's what keeps me up at night. The report itself isn't the problem. What most retirees do when they find out about this rule, the instinct they follow to protect themselves, is the one decision that can turn their own legal money into a federal criminal investigation. Last year alone, the federal government seized funds from thousands of Americans whose money was completely legal. I'm going to make sure you're never one of them. Under the Bank Secrecy Act of 1970, every financial institution in the United States, every bank, every credit union, every savings and loan is required by law to file what's called a Currency Transaction Report, ACTR. Anytime a customer makes a cash transaction that exceeds $10,000, that report gets filed on FinCEN Form 104 and goes directly to the Financial Crimes Enforcement Network, known as FinCEN. That's a bureau inside the U.S. Treasury Department, not the IRS. The Treasury, the bank files this report, not you. You don't fill out a form. You don't sign anything. You probably won't even know what happened. The bank has 15 calendar days after the transaction to submit it electronically, and they're required to keep records of it for 5 years. This happens millions of times a year. Millions. The vast majority of those reports go absolutely nowhere. Nobody calls you. Nobody shows up at your door. Nobody freezes your account. ACTR is not an accusation. It is not an audit. It is not a red flag on your account. It is paperwork, routine, automatic paperwork. But there's a reason I need you to hear that clearly, because what I'm about to tell you next is where people destroy themselves. When most people hear about the $10,000 rule for the first time, they have the same reaction. They think, well, if 10,000 triggers a report, I'll just deposit $9,000. Or they think, I'll break it up a little here, a little there, spread it across a few days. That decision, that instinct to stay below the line has a name. It's called structuring. And under federal law 31 U.S. Code section 5324, structuring is a crime, not a fine, not a warning letter, a federal crime. It is illegal to structure or assist in structuring any transaction with a financial institution for the purpose of evading the reporting requirements. You do not need to be laundering money. You do not need to be committing fraud. You do not need to be doing anything wrong with the money itself. If the money is clean, every cent of it, legally earned, legally inherited, legally gifted, and you deliberately break it into smaller amounts to avoid the $10,000 threshold, you have committed a federal offense. The penalties are severe. For violations involving less than $100,000 in a 12-month period, up to 5 years in federal prison and up to $250,000 in fines. For violations over $100,000 or connected to other illegal activity, up to 10 years in prison and up to $500,000 in fines. And in both cases, the government can seize the money through civil forfeit. I want to be precise here because this matters. In 1994, the Supreme Court ruled in a case called Ratzlaff versus United States that the government must prove 2 things to convict someone of structuring. First, that you knew about the reporting requirement. And second, that you knew that structuring itself was illegal. That's an important legal protection. But here's the reality. If you're watching this video, you now know about the rule. And if you go out and break up a deposit to avoid it, a prosecutor will argue you did it intentionally. Don't give them that argument. The IRS conducted a study that found 91% of structuring forfeitures involved legally sourced funds. 91%. These were people whose money was completely clean. They just made the mistake of breaking up their deposits. 9 out of 10 people who had their money seized for structuring weren't criminals. They were people like you who thought they were being smart. Now, most people think the $10,000 report is the only thing banks file. It's not. There's a second report called a Suspicious Activity Report, AS, and this one is far more dangerous because there is no minimum dollar amount. AS has no threshold. A bank can file a Suspicious Activity Report on a $500 transaction, a $200 transaction. There is no floor. The bank files AS when it sees behavior that looks like someone is trying to avoid detection. And the software they use is sophisticated. It's pattern recognition. It's looking for exactly the kind of behavior people think is clever. $9,000 deposited on Monday, $8,000 on Wednesday, $9,500 the following Monday. The system doesn't see 3 ordinary deposits. It sees a pattern and the algorithm flags it immediately. But here's what makes suspicious activity reports especially dangerous for retirees. You will never know one has been filed against you. Federal law prohibits the bank from telling you. It's a crime for a bank employee to inform a customer that AS has been filed. So you could be flagged right now and have absolutely no idea. CTRs are routine. S are targeted. And the difference between triggering one versus the other often comes down to a single bad decision about how you deposit your own money. The smartest thing you can do, the thing I tell every client, is stop trying to manage with the bank reports and start making sure your paperwork is clean, because paperwork is your shield. I want to walk you through 5 real situations. These are the exact moments where retirees make the wrong call. Scenario 1, selling a car. You sell your car privately for $14,000. The buyer pays cash. Perfectly legal, perfectly normal. You take the envelope to the bank. What people do wrong. They deposit $7,000, wait a few days, deposit the rest. That's structuring. What to do instead? Deposit the full $14,000 in one transaction. Bring a copy of the bill of sale, the buyer's name, your name, the date, the amount, and both signatures. The teller might ask where the money came from. You say, I sold my car. And you hand them the bill of sale. ACTR gets filed. Nothing happens. Your life continues. Scenario 2, a gift from your children. Your kids give you $15,000 in cash. Birthday, anniversary, help with medical bills. The reason doesn't matter. This is a gift. It is not taxable income to you. But your neighbor told you to deposit $5,000 at 3 different branches, or your friend said cash gifts need to be kept under $10,000. Both wrong. Both lead to structuring. Here's the truth about gift tech. In 2025, a person can give up to $19,000 per recipient per year without any reporting requirement at all. And even above that amount, the giver files a gift tax return, not you. The recipient of a gift does not owe taxes on it. Period. Deposit the full amount at your bank. Have your child write a 1-paragraph gift letter. Their name, your name, the amount, the date, and a sentence that says, this is a gift with no expectation of repayment. Keep that letter in a folder. You're done. Scenario 3, moving your own savings. This is the one that haunts me. You're moving money between your own accounts. Maybe you're consolidating after your spouse passed. Maybe you found a better interest rate. Maybe you're simplifying your finances. I had a client, a retired school teacher, 69 years old, recently widowed. While she was grieving, she decided to close one bank account and move the money, $23,000. Her own money, saved over 35 years of teaching. She moved it in small pieces, a few thousand at a time over several weeks. She wasn't hiding anything. She just didn't want to deal with a large transfer while her world was falling apart. 6 weeks later, she got a letter. The bank's software flagged the pattern. It didn't know she just lost her husband. It didn't know she'd spent her life teaching children to read. It saw repeated deposits under $10,000, and it filed a suspicious activity report. She was eventually cleared, but the legal fees, the months of anxiety, the stress on top of grief she was already carrying, none of it needed to happen. If you're moving your own money, transfer the full amount in one transaction. Keep bank statements from both accounts. Keep the transfer confirmation, one move, clean records, no pattern to flag. Scenario 4, an inheritance. Your brother passes away and leaves you $40,000 from his estate. The executive writes you a check, or in some cases hands you cash from a safe or safety deposit box. There is no federal inheritance tax for the vast majority of Americans. The estate tax exemption is currently over $13 million. Unless your brother was extraordinarily wealthy, there is no tax on this inheritance. But if you receive that money in cash and deposit it in pieces across multiple weeks, the bank sees structuring, not an inheritance, not grief. Structuring deposit the full amount. Keep a copy of the will, the estate settlement letter, or the executive's documentation showing where the money came from. That's your proof. File it and forget it. Scenario 5, Social Security lump sum. This one catches people off guard. If you delayed filing for Social Security, you may receive a retroactive lump sum payment covering up to 6 months of benefits that can easily exceed $10,000. When that money hits your account, a CTR is filed. That's fine. It's routine. But some retirees panic when they see a large government deposit and start moving money around to different accounts and smaller amounts. That behavior, even with Social Security money, can trigger a what des. Leave it alone. The Social Security Administration has records of every payment. Your bank has records of the deposit. Everything matches. The documentation exists automatically. Don't create a problem where there isn't one. Now, some of you have heard about a proposed $600 reporting rule. This caused a panic a few years ago, and there's still confusion about it. In 2021, during the Build Back Better Act debate, there was a proposal to lower the reporting threshold for payment processors, Venmo, PayPal, Cash App, Zelle, from $20,000 to $600. This was about 1099-K reporting for digital payment platforms, not bank cash deposits. That bill never passed. The Build Back Better Act died in the Senate in December of 2021. What eventually became law, the Inflation Reduction Act of 2022, did not include those reporting threshold changes. So the $10,000 CTR threshold for cash deposits at banks remains exactly where it's been since 1970, unchanged. There is actually a current proposal, the Streamline Act, introduced in October of 2025, that would raise the CTR threshold from $10,000 to $30,000 and adjust it for inflation every 5 years. As of today, that bill has not passed, but it tells you which direction this is moving. The conversation isn't about lowering thresholds, it's about raising them. For now, the rule is $10,000, plan accordingly. Let's talk about what happens at the bank window, because this is where I see retirees make their second biggest mistake. After structuring, a teller asks you about a large deposit. This is normal. They're trained to ask. It's part of their compliance obligation. What to do? Answer briefly and honestly. I sold my car. It's a gift from my daughter. I'm consolidating bank accounts. One sentence. Hand them whatever documentation you have. That's it. What not to do? Don't volunteer extra information. Don't explain your entire financial life. Don't say, and I cannot stress this enough, don't say anything like, I want to avoid being reported, or is this going to trigger something? Those words can end up in a S narrative. Don't offer to restructure the deposit. If a teller says, would you like to break this up? The answer is no, always no. Now, if you receive a letter from a federal agency, if someone from FinCEN or the IRS or the Department of Justice contacts you about your banking activity, stop. Do not answer questions. Do not sign anything. Do not try to explain yourself. You say 5 words, I'd like to contact my attorney. That is your right. That is the smartest thing you can say in that moment. Find a tax attorney or a criminal defense attorney with experience in financial matters. Do it before you say another word. And that brings me to the single most important thing I can tell you today. The report is not the crime. The crime is trying to avoid the report. The $10,000 rule is not a trap. It's not designed to catch retirees. It's a tool the government uses to detect money laundering and financial crime. But the system doesn't know the difference between a drug dealer structuring cash and a retired school teacher who got bad advice from her neighbor. The rule is simple. Deposit your money, all of it at once. Keep your records clean and never ever break up a deposit to stay under a threshold. Now, before I go, I want to give you something practical, something you can do today in 5 minutes that protects you for the rest of your life. Create a folder, physical or digital, whatever you're comfortable with. Label it transaction records. Every time you make a deposit over a few thousand, put 4 things in that folder. 1. A note describing the source, 1 sentence. Received $14,000 from sale of 2019 Honda Accord to John Smith on March 5th, 2026. Dated, that's your record. 2. Supporting documents. A bill of sale, a gift letter, an estate settlement document, a Social Security award letter, whatever proves where the money came from. 3. Your bank statement showing the deposit. 4. Any transfer confirmation. If you moved money between accounts, that folder is your entire defense. You will probably never need it. But if you do, if someone questions a deposit from 3 years ago, you'll be glad it took you 5 minutes to put together. There is no age exemption from this rule. There is no retirement exemption. There is no I've been a good citizen my whole life exemption. The law applies to everyone equally, but the people who keep clean records sleep well at night. I've seen too many good people, honest people who worked their entire lives get caught up in problems they didn't create because nobody told them the rules ahead of time. That's what this channel is for. If you know someone who handles large amounts of cash, a parent, a spouse, a neighbor, a friend, send them this video. 20 minutes now could save them years of stress later. Drop a comment. Have you ever deposited over $10,000? Did the teller ask you questions? Tell me your experience. I read every single one. And the most common situations will become future videos.